Welcome back to Investing Talk Podcast.
Today we're looking at brand engagement network.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find other investors like you.
Now, if you haven't heard of brand engagement network or the ticker BNAI, you might want to pull up a chair.
Oh, yeah.
Because, frankly, looking at this data, this isn't just another, run-of-the-mill AI hype stock. We're looking at a micro-cap company that is attempting a massive high-wire turnaround.
Turnaround from what?
They are trying to vault themselves from penny stock territory into becoming a legitimate foundational player in what we call regulated AI. So think healthcare, pharma.
And when you say high wire act, you are not kidding. I was looking at the volatility on this ticker, and it has been absolutely wild.
Right.
I mean, we're talking about explosive momentum. Depending on the day you looked, you saw surges of 55%, 112%. Moves that happen in days, just driven by news.
It's the kind of volatility that creates fortunes or, wipes accounts out overnight.
Exactly. It makes you stop scrolling and pay attention.
But it also usually signals a battleground stock where the market just can't decide if it's worth zero or billions.
But, and this is a huge but, we have to be real about the risks here right from the start. While the chart looks like a rocket ship, the risk metrics are flashing bright red. This isn't some safe blue chip stock. This is a battle between a balance sheet that, quite frankly, looks terrifying.
And a technology moat that could be a total game changer.
It's high reward, for sure. But the floor is a long, long way down.
That's the perfect frame for it. It's a binary outcome play, almost like a VC bet that just happens to be on the public market.
Okay, let's peel back the layers then. Let's start with the fundamentals.
Right.
And honestly, I'm looking at the trailing 12-month revenue here, and I had to double-check my screen.
It's dark, isn't it?
Stark is polite. If we look at the trailing 12-month revenue, we're sitting at about $75,000.
Not millions.
Thousands. Right, thousands. For a public company, that is. I mean, that's effectively pre-revenue. A local coffee shop does better than that.
And the margins.
Oh, the margins are deeply negative. We are seeing a gross margin of negative 17,837%.
That is just a staggering number.
Yeah.
It means for every dollar they bring in, they're spending a fortune just to keep the lights on and build the tech.
Exactly. Net earnings are sitting at negative $23 million. So purely looking at the now, this is a company burning cash with almost no money coming in.
You filter it out immediately on a screener.
You would, but if you stop there, you'd miss the whole story.
Right, because that's the now. The reason we're doing this is the future, and that story is changing incredibly fast. The narrative just shifted, really, with that Valeo Technologies partnership.
Okay, this is the $2 million deal everyone's talking about. But help me out here. Why does a $2 million deal matter when you're burning $23 million? It feels like a drop in the bucket.
Well, it's not just the cash amount. It's the structure of the deal that signals the pivot. It's a $2.05 million partnership, a licensing deal for African markets.
Okay.
But here's the key part. Valeo is taking a 25% equity stake in the new entity. Plus, there's a 35% revenue share on all the software.
Let's just pause on that. That's a huge distinction. A partner taking equity, they aren't just buying a product.
No, they're buying into the business model. They have skin in the game.
Exactly. It validates the technology in a way a simple sales contract just doesn't. A customer can walk away. An equity partner is kind of married to you.
Right. And speaking of sales, we can't ignore the other big catalyst, the vendor services project agreement. This is with a top 10 global pharmaceutical client.
And top 10 global pharma is one of those phrases investors love to hear. Their pockets run up.
They do. And the financial impact is starting to trickle in. They're expecting about $250,000 in development revenue in Q4 alone.
Now, compare that to the $75,000 annual revenue we were just laughing at. That's a huge jump quarter over quarter.
But the real kicker is the recurring license fees. Those are slated to start in Q1 of 2026.
So we're moving from $75K a year to potentially hundreds of thousands in a single quarter very soon. Okay, that's the growth story. But I have to play devil's advocate. We're in an AI bubble. Every company slaps AI on its name and the stock pops. Why is this one different? Why isn't this just another ChatGPT wrapper?
That is the multi-million-dollar question, and it comes down to their competitive moat. They aren't just using an off-the-shelf model. They use proprietary tech called ELM, Engagement Language Model. combined with RAG.
Retrieval augmented generation. We hear RAG thrown around a lot. For the listener who isn't a software engineer, break that down. Why does that matter to a pharma client?
Okay, so think of a standard large language model, like ChatGPT, as a really creative improvisational actor. It knows a lot, but if it doesn't know the answer, it might just make something up that sounds plausible. That's a hallucination.
Right. Which in creative writing is fine, but for medicine.
It's a lawsuit. It's dangerous. You can't have an AI telling a patient to mix the wrong medications.
Of course not.
So RAG effectively gives that improv actor a textbook. Before the AI speaks, it retrieves the specific, verified facts from the company's secure database, that's the retrieval part, and uses that to form the answer.
So it constrains the AI to the truth.
Precisely. BNAI's tech is built specifically for these regulated industries, HIPAA, GDPR, SOC2 compliance. It solves the hallucination and security problems that keep big pharma away from generic AI.
So it's a compliance mode. They've done the boring hard work of making sure the AI doesn't get the client sued.
Exactly. And they have the paper to back it up. 21 issued patents, with more pending. That creates high switching costs.
Good point. Once a hospital integrates a compliance system, they are not going to rip it out for something cheaper and riskier next year.
No way.
Okay, that's the bullish tech case. I can see why a pharma giant would pay a premium for safe AI. But I have to pull us back down to earth for a second.
The balance sheet, I knew you were going there.
I have to. The balance sheet is ugly.
Yeah.
The debt-to-equity ratio is 108.5%. That is high leverage for a company not making money.
And the cash burn is real.
Negative earnings of over $23 million. They're just bleeding capital.
They are. And that's the race. It is literally a race against the clock. They're relying on capital injections, like that Valio deal, not cash from operation.
It's like a startup living off credit cards, just waiting for that first big paycheck. It works until it doesn't.
But clearly the market is betting they'll win that race. It's a forward-looking mechanism. It cares about what you'll earn tomorrow, not what you burned yesterday.
Which is a perfect segue. Let's pivot to the charts to see how the market is reacting to all this, because usually a balance sheet this bad just tanks as a stock.
But here, it's reacting with enthusiasm, to put it mildly. We mentioned the breakout. The stock just shattered a multi-month consolidation phase.
What was the range on that?
The 52-week range was between $1.18 and $10.50.
And it just blew right past that ceiling.
Completely. We've seen it trading well above that, with surges towards $16. Technically, it's decisively above both the 20-day and 100-day simple moving averages. That's a classic signal the trend has shifted up.
And the metric I always check to confirm a move is volume. You can fake a price move on low liquidity. You can't fake volume.
No, you can't. And the average volume for this stock is usually around 6 million shares. Respectable.
But recently,
we've seen 44 million shares traded in a single day.
Wow. That's almost 8 times the average. That's a massive spike.
It tells you two things. One, retail is jumping in with FOMO. But two, and more importantly, 44 million shares.
Yeah.
That suggests institutional accumulation.
Right. That's too much for just retail traders on Reddit.
Yeah.
Big money is starting to place its bets.
And there was a regulatory catalyst on the technical side, too. The NASDAQ compliance.
Yes. Boring but critical.
It's crucial. They got the bid price back over $1, which removes the immediate threat of delisting. A lot of institutional funds literally cannot buy stocks that are under $1 or on a delisting watch list. This makes the stock investable, again, for the big players.
Okay, but looking at the technicals, I am seeing a couple of warning signs flashing. I'm looking at the RSI.
The Relative Strength Index. What's it telling you?
Well, analysts are noting it's high. When you see a stock surge 50, 60, 70% in a short time, the RSI usually screams overbought. It basically means that the buyers are exhausted.
That's fair. A pullback would be healthy.
It suggests that a consolidation is likely in the short term. I mean, nothing goes up in a straight line forever. Traders who got in at $1.18 are going to want to take some profits.
Agreed. A cooling off period would be constructive. But while the charts tell us what's happening, we need to understand how people feel about it.
Right. Let's check the pulse of the market in our sentiment analysis. Is this hype real, or is it just bots?
Well, the data here is fascinating. Looking at the quantitative scoring from Alpha Vantage, the news relevance is perfect, a 1.0. The media is talking about exactly what the company is doing.
Okay, and the sentiment itself?
Strongly bullish, a weighted average around 0.482. And what's really unusual,
That's that?
out of all the recent articles analyzed, 0 were rated bearish.
0. That's incredibly rare for a microcap. Usually you find at least one short seller report or a skeptical analyst somewhere.
Not here. The media narrative has completely shifted to the turnaround. The story isn't failing penny stock anymore. It's geographic expansion.
Which is the story investors are buying. We mentioned Valeo in Africa. There's Sky Salute in Mexico, that MOU with Nelson Mandela University. It feels like a global land grab.
It does. And I want to go back to that Valeo deal as an institutional vote of confidence. Putting $2 million of actual equity into the partnership, that's a massive insider signal.
It's putting your money where your mouth is.
Exactly. They aren't just buying software. They're buying a piece of the business. It signals they believe that equity is going to be worth a lot more later.
On the flip side, though, we do see some retail skepticism. If you look at places like StockTwits, there are still people calling it a pump and dump, mostly because of those financials we talked about.
And interestingly, that can actually be a bullish signal.
How so? I mean, usually you want everyone to agree with you.
Not always in investing. It's what we call the wall of worry. If everyone is euphoric, everyone's already bought in. There's no one left to push the price up. When you have skepticism, you have fuel on the sidelines. As the price moves up, those skeptics capitulate, they buy in, and that fuels the next leg of the rally.
So a hated rally can have longer legs. That's a great point. However, my job is to keep us grounded. We have to look at the red flags. So let's dive into the bear case.
This is where the rubber meets the road. We have to talk about the liquidity crisis.
I want to drill down on two numbers, the quick ratio and the current ratio. These are the can I pay my bills this month numbers.
Go for it.
The quick ratio is 0.01. The current ratio is 0.15.
For anyone listening who isn't an accountant, that is catastrophic.
It's critically undercapitalized. A healthy quick ratio is 1.0. 0.01 means they have almost no liquid assets to pay their short-term bills. It's like checking the couch cushions for change to pay the mortgage.
Which leads to the immediate implication.
They will likely need to raise money, and soon.
And that leads directly to risk number 2, dilution.
Right. If you have no cash, you can't get a loan with that balance sheet, so what do? You issue more shares.
And when you do that, the shares you hold in your portfolio become a smaller slice of the pie. They get diluted.
It's like you own a slice of pizza that's 10% of the company. If they suddenly cut the pizza into twice as many slices to sell them, your slice just got smaller.
Exactly. And the Valeo deal, while great, involved giving away equity in that entity. If they have to do that at the parent company level, shareholders will feel it. The stock price could drop just from the new supply flooding the market.
And then there's risk number 3, execution. We got excited about that big pharma deal, but you have to read the fine print.
Always read the fine print.
The revenue relies on performance and acceptance conditions.
There's the catch.
It is. The product is still in the prove-it phase. If the pilot doesn't work perfectly, if the AI hallucinates once, if the integration is clunky, that recurring revenue just evaporates.
And that's the thing with regulated industries. The barrier to entry is high, that's the moat, but the standard for performance is perfection.
Right. A chatbot for a shoe store makes a mistake. It's funny. A diagnostic tool makes a mistake.
It's a disaster. So the company is priced for perfection right now. The stock is up on the promise of revenue, not the guarantee of it. If they miss one milestone, the market will not be forgiving.
So, to recap, an exploding stock, a terrifying balance sheet, but a huge tech moat and massive deals in the pipeline. How do we grade this? Let's go to the verdict.
This is a tough one, but I think the thesis is pretty clear. This is an asymmetric trade.
Meaning the upside is bigger than the downside.
In terms of magnitude, yeah. The downside is volatility, maybe dilution. You could lose a chunk of your investment. But the upside, if the pharma and Valeo deals scale, this is a potential multi-bagger. You just don't see this setup often.
The Morningstar quantitative estimate seems to agree. They have a fair value of around $47.
Which implies an upside of about 185% from those recent $16 levels. Now, that's a model. It's not a promise. But it shows the potential if they actually capture that market.
And the moat is real. The compliance and patents, that's hard to replicate. But for me, this isn't a buy and hold for 10-year stock. Not yet. This is a swing trade.
I agree completely. The target horizon is probably 3 to 6 months. You're targeting the Q1 2026 earnings. You want to see if that recurring revenue actually hits the bank account.
You're watching for the transition from we signed a deal to the check cleared.
Exactly. It's high risk, high conviction, which means position sizing should be small. This isn't where you put your retirement money.
No, this is where you put maybe 2 or 3% of your portfolio that you are truly willing to risk.
Absolutely. So if we had to put a number on it,
The bullish score from our research is sitting at a 7.5 out of 10.
I think that's fair. A 7.5 reflects that the catalysts, Valio Pharma compliance, are strong enough to outweigh that terrifying balance sheet if and only if they execute perfectly in the next 6 months.
It's a race against the cash burn. If they win, you win big. If they stumble, it gets ugly fast.
That's the nature of these microcap turnarounds, but you have to admit it's going to be fascinating to watch.
Oh, absolutely. I'll be watching those earnings reports like a hawk, and specifically looking for any announcement of a capital raise.
And for you listening, the key is to watch for that transition from one-time development revenue to recurring fees. That is the signal the business has stabilized.
That's the deep dive on Brand Engagement Network, a wild chart, a precarious balance sheet, and a potentially revolutionary technology.
It's definitely not for the faint of heart, but those are often the most interesting stories.
Make sure to subscribe, like, and comment. Let us know if you are brave enough to touch this one or if those debt numbers scared you off. We'll see you in the next one.